Okay, thank you for being here tonight. What we're going to talk about is bankruptcies, foreclosures, short sales, judgments, and disputes. And the question is, can I still qualify for a home loan if I have these things on my credit? Well, this is what we're going to cover. Can you get a loan? If and so, when can you get a loan? Bankruptcy, Chapter 7 or Chapter 13, a foreclosure, a short sale, or a judgment. Now, I always say at this point that if this is not going to be what you're looking for as far as information, then I encourage you. I mean, we have a lot of videos. We cover a lot of different subjects on a weekly basis. But if you have some of these things, if these are issues that you've had in the past, 1 year, 2 year, 3 year, 4 year, 5 year, 10 year, then it might be some information that you might want to find out about based on if you plan on buying a house anytime soon. So what we're going to do is we're going to move on. We're going to go through this. I like to go through this information pretty fast because what I want to do is I want to give you some information, but really what my goal is to get you to call me. I mean, the truth is that everybody has a scenario that they want to detail, and the general information is fine for a lot of people, but you're going to want to find out specifically what's going on in your particular case. Bankruptcy Chapter 7 and 13 are where we're going to start. And Chapter 7 is when you ask for protection from your creditors. And at that point, you're not able to pay any of your debts. So this is a pretty dire circumstance when something has gone really bad in your life, and particularly your financial life, and you need somebody to help you bail out. And you're basically saying, I can't pay anybody. I need to start completely over. I am out of here. Now, Chapter 13 is a little different. You're still asking for court protection, but you still have an income flow. You can pay most of your debts back over a designated time frame. And you can see in both of these, they're perceived differently by the mortgage industry. And a home lender would naturally have a problem with either of these events. I mean, a conventional loan, the timelines are a little longer. FHA is a little, FHA is a little less. A VA even less than the FHA. So what we want to do is we want to talk about those. And, you know, I am sorry that anybody would go through any of these type of things, but they do happen, and they happen consistently, and we have to figure out what the repercussions of them are and how you get around them. So FHA lender waiting for bankruptcy, the FHA lender waiting periods, and we're going to talk about bankruptcies first. Now, Bankruptcy Chapter 7 or 11, 7 is for personal bankruptcy, 11 is a business bankruptcy, and the waiting period for FHA is 2 years. I'm having trouble with my glasses here. I can read this better this way. 1 year with extenuating circumstances. Now, there's a list of the extenuating circumstances that I can give you. I'm just not going to go over them tonight because it's tedious and we're just not going to do that. Usually it has something to do with it being beyond the borrower's control, and it was some event. Could have been a medical issue, or it could have been a business slowdown. The key part of this is that the underwriters are going to require you to document what happened. And if you can do that, sometimes the waiting periods are shorter. On Chapter 13, it's 1 year with 12 months satisfactory payments to the trustee. You have a trustee, usually an attorney, that acts as the trustee. You must have the court's permission to incur new debt. And new debt would be a new house that you're trying to buy. If it's not fully discharged for 2 years, the loan must be manually underwritten. Now, a lot of people don't understand what manually underwritten means, but when they manually underwrite an FHA loan, the criteria, the guidelines, are reduced, and the reason that they're reduced is because there's something that's causing that loan to be come under scrutiny, excuse me. All right, so there's a difference between Chapter 7 and or 11. Don't see many 11s. Those are business guys. See a lot of Chapter 7s and a Chapter 13s. And really, there's just a chart. And one of the things that I'd want to offer to you is if you want the chart that shows you these designations, then I just encourage you to email me. And my email is real simple. It's Mike, KMG, at gmail.com. KMG stands for Kingwood Mortgage Guy. All right, let's go to the next slide. Conventional lender waiting periods. And this is the first one we did was FHA. Conventional guidelines are a little tougher. In the bankruptcy Chapter 7 or 11, the ones we went over there, where it was 2 years on the FHA, it's 4 years for a conventional. And they do have a 2-year with extenuating circumstances. And again, remember those are indicated it was circumstances that happened beyond the borrower's control. And again, the need for documentation is a big deal. On the Chapter 13, it's 2 years from the discharge date or 4 years from a dismissal date. And there's a difference between the discharge date and the dismissal. And it's subtle, and I'm not going to talk about it right now. But on the ultimate form that you get after you've gone through a bankruptcy, they do end for one reason or another. There's going to be a document that says it's discharged or it's dismissed. Usually, dismissal means it never got completely paid off. A discharge and I may be exactly wrong on this, but I think a discharge date is when you have gone through a 13, you've paid everything out, and the thing is completed and finalized. No, I could be wrong on that. All right. Here's a big one, FHA foreclosure waiting period. Now, there was a lot of foreclosures that happened anywhere between 2007 and 2011, and it was based on the crazy mortgage stuff that was going on between 2002 and 2006. FHA foreclosure waiting period is shorter than conventional. It's 3 years from the foreclosure date of the case assignment or an application that was taken. Very specific, and we do a fair number of these because there are a lot of people that went through this period and they got caught up in what was going on at that time. The credit must be reestablished. It means they must have a consistently showing that there are signs that they're able to handle the monthly payments that are going out. And the property must have changed hands 3 years to the day. So not 2 years and 364 days. It has to be 366 days, and the property has to have changed hands. So one of the things that I do when we get one of these foreclosure things is I go back into public records. It doesn't matter where it was in the country. I can look pretty much at all of them. And what we do is we look to see when the property changed hands. And in some cases, that property stays in the borrower's hands for a long time, eliminating the opportunity for them to go through a process. I mean, the 3 years never starts because the institution never took that property back on their books. And it's a problem. It doesn't happen very often, but it does happen. VA foreclosure waiting period. Now, the VA takes care of the vets, and the waiting period for VA is 2 years from the foreclosure date. Now, the property must have changed hands for 2 years, so it's kind of the same thing I just mentioned in the VA. Credit must be reestablished. There are credit criteria, credit scores that you can have a minimum credit score for the VA. And then you can do 1 year with current satisfactory credit under special circumstance. So with the VA, if there's a foreclosure, 1 year later, if everything kind of falls in place just right, you can get a new VA loan. And VA loans are the best gig out there for the vets. I mean, they're the best thing. Okay, conventional waiting period after a foreclosure. Well, conventional says, you know what, if you've got a foreclosure, we don't want anything to do with you for 7 years. And they do have some interesting parts to that. 3 years with extenuating circumstances. Again, the same thing is that it was a non-recurring, sudden, significant, and prolonged reduction in income. They have to have proof of catastrophic increase in the financial obligations, and everything's got to be verified. It's hard, particularly if you're waiting 3 years, to even keep up with all those documents, but if you do, you can do it in 3 years. They have some caveats, though. A deed in lieu of foreclosure. Some people know that they're in trouble, and when they know that they're in trouble, what they do is they just say, you know what, take my property, and and I'll just walk away, and you can do whatever you want to with it. They leave it in good shape. It's easier to sell for the institution that has the mortgage, or They do a pre-foreclosure sale or charge off of the mortgage. That's an option. And when you do that, the waiting period is reduced. 4 years is obviously better than 7 years, and a year longer than the FHA, but 2 years with extenuating circumstances. So now they're getting pretty aggressive. Now, I've tried a couple of these, and I can tell you that the conventional lenders are a little sensitive about foreclosure, and that they don't like them at all. So it's tricky. Sometimes it's just easier to do FHA because if it fits in the FHA guidelines, then it's going to fly right through. What one of the guys I did just went back and did a conventional refi after that, and it was easier to go from conventional from FHA to conventional after the time period. So it was a lot easier than doing it that way. All right, judgments. Judgments are a nasty beast. I'm telling you, they are tough. Judgments indicated a borrower may have had a disregard for credit obligations, and the creditor filed a judgment on them. A lot of times when we see it, this kind of stuff happens, it's from out of state. In Texas, it's a little bit harder. The borrower, excuse me, the borrower must explain what happened, and they must have had at the time a disregard or an inability to manage debt. It's a negative. All judgments must be paid off before the mortgage loan is eligible for approval. So if you've got a judgment, you're usually going to have it resolved. Exception could be for if a borrower has an agreement with the creditor to make regular and timely payments. They particularly like you to have a history of at least 3 months of making those payments. They don't allow you to just pay 3 months all at one time. And so they want to see that this is not something that's brand new. Borrower must provide proof that these were paid in time and in accordance with the agreement, and a minimum of 3 months of the scheduled payment. So again, this could delay something. Obviously, if I look at your credit, I'm going to share this information with you and give you an opportunity to fix those kind of things. But that's one of the ways that this works. Is I try to work as your advocate, and if we're trying to buy a house, I'm going to guide you on what these guidelines are so that we at least have a clear understanding of what needs to be done before we move into a house. All right, disputed accounts, another one of the stressful parts of this. And at one point in time, there was a philosophy that if you disputed an account, it was basically removed from your credit score and your credit scoring. And that, in fact, is what happens. Used to, underwriters would not look past that. If it was disputed, they'd say, well, there's obviously something wrong with that. There could be an issue, so they just let it pass. Well, that has been a couple years, been a handful of years since that used to be the case. Now, the underwriters require that any dispute that's on your credit be resolved. Well, what the credit bureaus do, or the creditors do, is if it says there's a dispute, it just says on the line underneath the credit, there's a little notation there that says account disputed by consumer. Well, they don't let that stay. And so we have to have the consumer remove that dispute, and it can take anywhere from a week to 30 days, depending on which creditor you're dealing with. And then once they dispute it, we have to get it onto the credit bureaus that says the dispute's removed. And it's a hassle, but I'm going to read this. Existence of potentially inaccurate information on a borrower's credit report must be reviewed by the underwriter. That's the first thing. Accounts that appeared as disputed on the credit report are not considered in the credit score. So here's the scary part, is that if you've disputed an account and then we pulled your credit and your credit is just above qualifying, depending on the age of that account, when you remove that dispute or say that that's not disputed anymore, it can lower your credit score again. This is a scary thing for somebody that's just over the qualification level. Now, it usually has to do with the time of when the creditor collection account happened or what the deal was, but they can be nasty, and you have to have somebody that knows how to deal with these before you do it, because you don't want that ugly surprise of getting this notice late in the loan process. Not good. But the bottom line is, therefore, it said that on the screen, all disputes must be resolved. So just know that. If we see them on there, we're going to tell you about them early. Wow. Is that it? Okay. Normally, I have a couple screens up that are, and I don't tonight. Hopefully this has been helpful. My name is Mike Durr. I am the Kingwood Mortgage Guy. I try to do these once a week so that we have some bit of information that's going to help you get a loan. I'd love for you to call me. My number is 281-348-9899. I'll probably have it on the extended version of this when make it into a video and put it on the Homebuyer website. Also, I want you to check out a new website that we're doing. It's called Houston Real Estate Today. And what it is basically a version of being able to look at every property in the Houston Metroplex to see what's available for sale. And you can search by price range, by area, by city, by zip code. A lot of options there. And of course, it has us tied to that. So we'd love to be able to connect with you. It's totally free, and we encourage you to use that. So anyway, this is Mike Durr, Kingwood Mortgage Guy. I'm signing off. I look forward to seeing you next week. Talk to you soon. Bye-bye. You are sharing your screen. Okay. So, testing 1, 2, 3. Now, hello everybody. This is Mike Durr, the Kingwood Mortgage Guy. I am recording from my studio at 1521 Green Oak Drive in wonderful, lovely Kingwood, Texas. And what I'm going to be doing here is going through a PowerPoint that is important to me right now, mainly because I've had some people, let's see if I can do that. I need to get some feedback here. Can somebody tell me what they're seeing right now? Okay. Share. Demo, what's this? Share the content. Choose what you like. Okay. Okay. Now the test is, this is about bankruptcies, foreclosures, short sales, judgments, and disputes. That's kind of interesting. Let's take a couple few things out of the way here. So, bankruptcy, foreclosure, short sales, judgments, and disputes. Can I still qualify for a home loan if I have these things on my credit report? Well, that's the question we're going to answer tonight. And what I wanted to do is, let's see if I can move this screen around. Well, it's going to be one of those nights. And now we'll try it. This ought to work. Well, okay. I had this from before. From beginning. Aha! All right, we're cooking now. Okay, we talked about that. What we're going to cover tonight, can I get a loan if, and so, when? If you have a bankruptcy, Chapter 7 or Chapter 13, what's the waiting period for that? A foreclosure, if you've had a foreclosure in the past, obviously you can get a new mortgage at some point in time. What we're going to talk about tonight is we're going to talk about when that is, when you would get one. And let's